When it comes to cash value life insurance and policy loans, when I take out a loan, do I pay interest on my own money? The answer is yes, but we've got a big but here. You continue to earn interest on your entire cash value, the money in cash value and what you've loaned out, a lot like how appreciating real estate works. Let's get into a couple of examples. We're going to look at some charts and specific illustrations as well, but first we're going to explain exactly how it works. So let's assume that we have a whole life insurance policy earning 5%. I've got $100,000 in there. If I do not touch it, we'll assume that I continue to earn that 5% on my policy cash value. Now, if I elect to pull out a $50,000 policy loan, what happens here is I receive that $50,000 loan, tax-free, provided the policy is not a MEC, and there is a cost to borrow, which we will assume is 5%. So I have a 5% interest rate that when I pay that loan back, if I decide to pay it back, that 5% interest goes to the insurance company. So cost to borrow, yes, that interest rate goes to the insurance company. However, I continue to earn the same 5% or whatever the company's paying via dividends and guaranteed rate on my entire cash value. Meaning I pulled out $50,000, paid 5% to them, they are still going to pay the same 5% earning rate on my entire $100,000 as if I never touched it in the first place. Meaning that 5% interest is on the $50,000 remaining in cash value or equity and the $50,000 that I have loaned out. So here we go, 5% interest goes to the insurance company. However, the insurance company credits 5% interest to the full cash value. Now, how the insurance company does this is what they collateralize is primarily the death benefit. And you're going to see this in an example. When I borrow from my life insurance policy, if I pull out $50,000, I will see my death benefit reduce dollar for $50,000. Meaning if I had $500,000 in death benefit, I pulled $50,000 out in a loan, I would see my death benefit drop to $450,000. How this relates to real estate. Let's pretend that I have a property and the appraisal value appreciates at 5% every single year like clockwork, no matter what happens in the economy. So I've got a value, we'll assume that it starts out at $100,000. I elect to borrow or loan against it, let's assume $50,000. We'll assume that the cost to borrow is 3%, as interest rates are very low right now. So what that means is that I will have remaining equity of $50,000 in my property. So that 3% interest expense goes to the lender or the bank. However, the 5% appreciation is on the full property value. The collateral is our real estate. Very much like a life insurance policy. The cash value and real estate function very, very similar, meaning if I take a loan against my asset, what happens? I continue to yield appreciation on my entire asset, even though I have borrowed or pulled money against it. Let's demonstrate this with some actual numbers because conceptually this can make sense, but it's always good to see it. I want to see the actual numbers and I'm a nerd with this stuff, so I like going into them. So anytime we look at a policy loan, what I like to look at is what does that policy look like when I don't take out any loans? When I pay money in, just let it sit and grow. Okay, here's what the policy looks like. Now when I actually put things in motion, put it in action, what does it look like when I borrow and repay? Compare it to the original growth sample. We do this with everyone we work with, whether it's in the initial sales process and we're showing you, hey, here's how the policy works, or if it's after the sale during review meetings and such, or if you're looking to purchase property or anything, you want to see how that loan will work. So what we have here is a 35-year-old male funding a policy at $50,000 just for 5 years. Up until age 40. That's all he wants to pay. What's highlighted in yellow here represents his break-even point between years 4 and 5. So this is a very cash-rich design. We design it for minimum insurance premium, minimum compensation, maximum cash value. This gives the consumer the maximum amount of value. One, for his cash value to appreciate at a fast rate from start to finish, but two, more access to capital to take advantage of opportunities as they present themselves. The opportunity cost, that's the biggest thing in my opinion. If a policy does between 4 to 5%, that's great. However, what I am interested in as a business owner is if an opportunity pops up, if we want to hire more people, rehab another building, purchase property, whatever it might be, having access to the capital, that's what intrigues me. So designing a policy where we have access to maximum capital from start to finish puts me in a better position to take advantage of those opportunities. Let's look at the loan treatment now. Same policy, but with taking loans and repaying them. So the first thing we do here is take out a $100,000 loan, policy year 3. My question, if this is me, if I'm the consumer, is what is the impact of that policy loan? How does it impact my policy? So what happens, my cash value is the equity, the gauge determining how much I can borrow. So if we compare that in year 3, I pulled out $100,000, I've got 136, whereas over here, I've got 141, where I never touched it. So again, the cash value, that determines how much you can borrow from the policy. Now, the theme of this video, we pay interest on what we loan, but we continue to earn interest on everything. So the company tells you and I that they're going to continue to pay dividends on whatever money's in cash value and that loan balance as if we never touched it in the first place. Okay, that sounds great because I've got guarantees with the whole life insurance policy, goes nowhere but up over time. I can do a lot with this. Let's break it down and see how it works. The $100,000 loan at 5%. We pulled this directly from the illustration like we always do. Loan interest, $5,000 for the first 3 years, where he begins to pay interest only. So you see the interest payment. Paying interest is optional. In this example, he's going to cover it, $5,000 per year. And then he begins to pay down his loan principal at $20,000 per year. You'll notice when he does this is after the funding period. So while he's pumping money in, he says, I can't swing the loan payment right now, or I can, but I don't want to. After I get the amount of money in that I wanted to, this $250K, then I'll start to redirect my cash flow at the $20,000 per year payments towards the principal, while at the same time I'm covering the loan interest. So what I want to also highlight is if I look at year 6, when he's 41, he makes a principal payment of $20,000 and he covers the loan interest expense. So his net payment or net out of pocket that year was $25,000. These payments here, interest payments and the loan interest, these two columns are going to be identical in terms of the numbers. That's money going to the insurance company. So what I want to know is, okay, so the insurance company does benefit off of this. Also, if I die with a loan outstanding, a lesser death benefit is left to my beneficiaries. However, when it is repaid, what's the advantage? There's always pros and cons to everything. I want to understand it from both perspectives so I can make an educated decision. Year 10, the loan's paid back. He's 45. What's your cash value? $318. What about on the example when you just let it sit and grow? $318. Death benefits are identical as well. So what do we see here? Did we pay interest on our own money? Yes. You can tally up those interest payments there. That was interest that went to the insurance company, no matter how we swing it, or how we explain it, I should say. But with that said, excuse me, we continued to earn interest on our entire asset as if we never touched it in the first place. No lost opportunity cost, very, very similar to borrowing against our real estate. If I've got equity and I take a loan out and assuming my real estate continues to appreciate forever, very similar in that respect. So back to the original question. Do I pay interest on my own money, on my cash value? Yes, but we do continue to earn interest on our entire cash value as if we never touched it in the first place. And as a last side note, because I always like to go into more information, is right now in the very, very low interest rate environment we're in right now, this loan interest expense of 5%, many view as high. They say, hey, I get it, it's very convenient to borrow from a policy. However, I can get a much better interest rate elsewhere. And if I'm earning the same rate no matter what in the policy, 5%, regardless if I borrow or not, why would I take a 5% loan here when I can get a 3% loan elsewhere? Well, you can do that as well. We can even take a policy to a bank or a specialized lender and say, hey, here's my cash value. I'd like a loan for $50,000 if I've got $100,000 in there. And what we can do is assign our cash value as collateral. It's a cash value collateral loan where they give us a loan a lot like a line of credit. We give up a little bit of control, reliable to make interest-only payments. We can pay it back at our discretion. Typically, there's a term, whether it be 5 years, 10 years. They review the loan again. It may be a variable interest rate. There's a couple things we want to be aware of, but we've got more information on that. My point is, however, we can leverage the policy from a growth standpoint. Core benefits of a policy: safe, liquid, tax-free. And then at the same time, leverage it to get a more attractive interest rate, almost in the same way we would leverage real estate, only here we've got guarantees that our cash value goes nowhere but up over time. So, know this was a decent amount of information. If you have any questions, feel free to reach out anytime. And as always, I hope this helps. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.